Good afternoon, everyone. Welcome back to the channel. So we have a very special guest back today again, Mike Khouw from YieldMax. Welcome, Mike. Thank you so much for coming back.
Oh, it's my pleasure to be here. Thanks for having me.
Yeah, so we were just talking offline a bit about the market and the choppiness and all that, and you had some theories. Thought we'd just have you run through really quick, your theories on the recent market choppiness and the bull market and all of that.
I mean, first of all, it should be said that every bull market climbs a wall of worry. This one is no different in that respect. The question every investor is always going to be asking themselves, okay, at what point do we need to start getting concerned? At what point is it possible that some of the background noise that people are concerned about suddenly turns into a legitimate reason to sell and for prices to move not lower? They are lower today. This is, certainly an above average move. We can put some numbers around that for perspective. So right now the VIX is about 19. Let's just round it up to 20 to keep the math easy. So the VIX is basically using a series of in some cases it's interpolated, but generally it's 30-day forward-looking options prices on the SPX index, which is a good proxy for the S&P 500. And it tells us what the options market's expectations are for volatility over the following 30 days. The volatility from an options trader's point of view is the annualized standard deviation. So if you want to know how does that translate to the moves that you would expect to see on average for a day, if the VIX was 16, you can divide by the square root of time. So if there's 256 trading days in a year, square root of that is 16. 16 divided by 16 is 1%. That becomes the standard deviation for a single day. Now, the standard deviation is not the same thing as the average move that you would expect to see, right? So the average move is a different statistical measure, but it's related. It's called the mean absolute deviation. And that is the standard deviation times the square root of 2 divided by pi. We don't need to get all mathy. All you have to do is know that that number is approximately 0.8. So
Awesome.
what you know is that if the VIX is 16, the average move on a given day is about 80 basis points. When the VIX is 20, the average move is about 1%. Right now, the VIX is 19. We are down, as I speak to you now, let's just take a quick peek at the day's change. So the move right now is about 110 basis points. So that is greater than the average move. That is greater than actually the standard deviation. And it's certainly greater than the standard deviation for the VIX was yesterday. So this is not the kind of move that you would expect to see, but it's not huge. It's not catastrophic. But I will say this. If you start to see more of these types of things, moves that are outside of the boundaries of what you would normally expect, to me, that does become a little bit worrisome. I've seen it in other market conditions where people felt like the market was extended. And let's bear in mind that the market's short-term price behavior has a lot more to do with feeling than reality. It is not that the discounted cash flows over the next 10 years somehow changed markedly between yesterday and today. It's people's perceptions of those numbers that have changed. And so when I start seeing a lot of gaps in prices, when you start seeing stocks gap lower, to me, it just suggests that investors are getting nervous. They're getting a little bit tired. They're very quick for the exits at the first sign of trouble. And that's a different kind of a mentality than the buy the dip mentality that I think has persisted for the bulk of this bull market. So that's the kind of thing I would keep an eye out for. We saw that in the tech wreck. Cisco was the leading stock of that time, much like Nvidia is the leading stock of this one. And you would see these situations where suddenly the stock would move 5-6% in a single trading day. That kind of price behavior is not healthy. Right. We haven't seen that yet, but that's the thing to keep your eye on. So if you're thinking to yourself, do I sell now and wait until after Christmas? I don't think we're there yet, but if you start seeing that kind of price action, that's usually troublesome.
Right. That was a great explanation of standard deviation and all of that. I kind of felt like I was back in stats class, but you probably lost some of the audience with that one. I mean, we had someone here that said, they failed algebra, so you lost them with that. But I thought that was really good explanation.
Yeah, I mean, the important thing for people to understand, you can get as mathy in this area as you like. If you're the kind of person that likes to nerd out and really get quanty,
some people do.
Finance is one of those places where the sky's the limit.
Absolutely.
But you don't need to. It's just really the idea is to have a general sense. Everybody who's watching right now has a sense of what a percent is, what 1% is, what 5 is, what 10% is. A 1% move for the S&P is above average, right? A 2% move is significantly above average in a given trading day. And a move of 3% or more is extraordinary within a given trading day. If you don't want to nerd out and remember how to use one of these old HP12Cs, like I still use this old calculator. When I first started trading on the floor, this was an HP12C Platinum, which you can program more lines of code into this thing. I think you can put like an additional 23 or something lines of code into it.
Wow.
I still use it. These things are incredibly durable, and I still like to use it. But at the end of the day, I still do a lot of things very back of the napkin because it's too easy to get lost in the minutia of really precise calculations. It's the big things that drive asset prices. It's not the little ones. I have an interesting story about that, which I'm happy to share if we have time.
Go for it. Yeah.
So back in the day, shortly after I had left the trading floors, I was working for a hedge fund. I was kind of a junior analyst. This is more than 20 years ago now. And it was in Los Angeles, a very deep dive, fundamental approach to long short equity. We had, big hedge funds. One of the services that investment banks offer to hedge funds is they get you what's called corporate access. So that means that if you're an investor and you want to talk to management of a publicly traded company or some company that you're interested in investing in, the investment banks will set those meetings up. And if you're big enough, they'll come to you. Wow. So it was Canadian oil sands. Now, this was not a company I happened to be looking at, but I had a lot of experience trading energy stocks, the oil service index stocks in particular, and also energy commodities. I traded natural gas options, oil, and oil options. And I got a phone call, and somebody was in the conference room that said, "Can you come in and just sit in on this meeting?" And it turned out that the meeting was with the senior management of Canadian Oil Sands, which is a company that was mining Canadian oil sands. So basically you have, bitumen surrounds pieces of sand, and basically they inject steam and basically break the oil off of the oil sands and harvest it this way. Yeah. In any case, we had the CEO, the CFO, and the head of investor relations all sitting in our conference room, and they were, sort of telling us their business. And we had an analyst who covered the company, and the analyst was asking them various questions, and they were just sort of going over the numbers at a very high level. This is how things are going. If we think oil prices are here, this number, that number. And at one point, our analyst said, "You didn't include the royalties." And the CEO said, "What?" He said, "The royalties that you guys have to pay to the Canadian government for every barrel of oil that you take." Wow. Which, by the way, was a pretty nominal number. It was like 50 cents a barrel or something like that.
Oh, okay.
And the CEO said, I don't really think it's that important. And the analyst said, "What are you talking about?" He's like, if over this period of time, it's going to be $10 million. Mm-hmm. And the CEO said, "I think you need to worry a little bit more about the price of oil and a little bit less about the 50 cents a barrel we have to pay to the Canadian government." Right. I remember the analyst just still had his head down, and I was sort of sitting there, covering up my eyes, thinking, that's really getting lost in the forest for the trees, right? Yeah. If oil goes to 100, that's what you have to worry about. It's not the 50 cents a barrel. Same thing is true here. We can get caught up in minutia all day long, but the things that are going to affect your investment returns far more is the big picture stuff, because the little stuff is often unknown or unknowable, and it's also not that material. Right. So leave it alone.
Very true. Yeah, interesting story. It's kind of almost like the expense ratio for a fund manager or for the manager, right?
That's right. You get 20% returns if they're charging you 100 basis points. It can add up. Steve Cohen charges, what, 45% of the upside? That matters.
Oh, I get it. Like if it's too high, I mean, like, the whole thing with mutual funds and all of that. But I mean, on more reasonable ones, it's not a big deal if you're making a decent amount of money.
Mm-hmm.
Anyway, okay, so let's talk about, one of my favorite of your ETFs, Tesla. Now, the question, I get this from a lot of the audience because we've got people that have been in YieldMax since the beginning. Are you really kind of boxed in by the prospectus with that? You can pretty much only do like the synthetic covered calls, or for existing funds, are there possible options for, like, no pun intended, but like, are there possible like additional options you could maybe add or amend to the prospectus that may allow capture more upside?
So it's interesting that you mentioned this. So let's. Is it a straightforward covered call, or can you also do things like covered call spreads? Right, we can do things like that. It should be said that the fund manager cannot do whatever appeals to them if it falls outside of what is disclosed among the sort of approved strategies described in the prospectus. This is just a general thing for all funds. It's one of the reasons, incidentally, why some YieldMax funds have evolved. The documents have evolved over the course of time.
Yeah.
Whether it has to do with the frequency of distributions, whether it has to do with the nature of the strategies that may be employed and how flexible they can be.
Mm-hmm.
Let's start with the sort of a high level thing, which is that for a covered call fund, the strategy is never going to deviate materially from that, even if the prospectus is amended. So, for example, Tesla is never going to become a put buying strategy on Tesla, or, even to make an argument ad absurdum on Rivian, right, or Lucid. It's never going to deviate that materially. It is a normal business course for larger funds to change some elements of their investment strategy over the course of time to adapt to. It could be changing market conditions or regimes, or even what's available to trade. So this isn't applicable in the case of Tesla at the moment, but let's say that they went to dailies in single stocks, for example, single stock options on Tesla. Well, you might want to have the flexibility to trade those. You might want to have the flexibility to be able to trade calendars. That is to say, okay, I want to sell call spreads on Tesla. I know that these near dated options are going to decay much more rapidly. And when the term structure, that's the relative price of options throughout time. So what's the implied volatility of options that expire in a week versus a month versus 3 months versus a year? If they went to dailies, what's the relationship of the dailies to the weeklies and so on? So that we refer to that as the term structure. If the term structure made it look appealing to say, for example, sell daily upside call options in Tesla, but own some longer dated, further out of the money calls as sort of a measure of protection so that you can harvest yield, but still capture upside in the event that you get a really profound upside move. The example I would provide, there's two really, was NVIDIA and AMDY, right? So both of those were selling call spreads. Both of them had sharp upward moves. And in both cases, these are covered call funds that were able to capture a significant portion of the upside move in the underlying asset. In NVIDIA's case, I think it was 11.5 versus 15. If you were just selling covered calls, you couldn't do that. You would have gotten 3% upside in the stock plus another, 150 basis points out of your covered call, and you'd have gotten less than a third of the upside move. In this case, it got, 2/3 of the upside move. So there is some flexibility, but understand that those single stock covered call ETFs, which are also, by the way, they're constructed, one, to democratize covered calls, and two, so that you can construct portfolios out of an assortment of them. Right. So if you wanted to have a basket of stocks, you can pick whatever stocks you want. If you want to have a basket of covered calls, this makes it a whole lot easier to execute. You can imagine that from an individual investor's point of view, in some of these stocks, if you have 20 stocks in a portfolio and you want to run a weekly covered call strategy on all 20 of those stocks, that's pretty much a full-time job now, right?
Oh, yeah.
So it's buying a bunch of these in the stocks that you prefer is pretty much the only practical way that a person who actually works from 9 to 5 could do that. And it's incumbent upon the fund manager to ensure that it adheres to the chosen strategy, because it's hard enough picking the stocks without guessing whether or not the fund manager is going to, arbitrarily decide that they want to change something. So the prospectus and the guardrails that puts in place, I think I can safely call them that, are there for a reason. But that we will, if we find that the constraints of that, if those guardrails prove to be too inhibiting in terms of performance, we might file to amend the prospectus. And we've done that a couple of times, like I said, for distributions and, for mild amendments. But I think covered calls and just covered call spreads are pretty much what you can expect to see in those single stock funds, pretty much indefinitely. Again.
Okay.
Yeah.
Well, that's good. I mean, there are other options we have. It's good that we're not completely boxed in with that, because I see a lot of the very same sentiment from the audience, and you probably see the same thing going on other channels. To sum it up best, I generally see, maybe not the most articulate way to say it, but Tesla goes up, Tesla doesn't, and they're mad, So
yeah, I mean, in general, I can take a look. I'm have my Bloomberg up here.
It is going up, because I do this the comparison, it is going up, but not nearly. And I know the upside's capped. I get that, but Tesla's at almost all-time highs. So
that is is correct. So basically, look, I mean, one of the biggest challenges for a covered call strategy is not if the stock steadily goes up, selling some upside calls. If you can imagine just the home run strategy is you own the stock runs to your short strike, or maybe just a little bit above it, but not as much as the premium you collected, and you just do that again and again and again. Mm-hmm. And if it just did that as a diagonal line from the lower left to the upper right, that would be the perfect situation for a covered call. It is a little bit more challenging if the stock chops around as it does that. Because if it moves sharply higher in a short period of time, you'll still participate to a degree, but your upside is going to be limited by the fact that you sold an upside call. Mm-hmm. And if it moves sharply lower, you're going to be a little better off because you collected the call premium than you would have been just by buying the stock. But if the stock falls so sharply that that decline vastly exceeds how much you collected for that call, you're not going to feel that comforted by the incremental performance. If I say, the stock fell 12% over period A to period B, and, you were only down 10.5%. No one's going to say, oh yeah, I want to hold my hand up. I love that. You're down 10.5%. You're down less than the stock, but it's not great. So that very choppy situation where it moves sharply higher in the short term, sharply lower in the short term, becomes harder for covered call strategies to navigate. But those types of environments tend not to persist indefinitely. You go through, that's what I was talking about, regimes. Those are the regimes where selling call spreads are going to work out better. But in the long run, that doesn't tend to persist. Volatility is a mean reverting process, and you expect it to kind of normalize over time and settle down. We have had this year a couple of periods of extraordinary volatility, both for equities generally and for some of these stocks specifically. Yeah, that becomes a little harder to navigate, admittedly, but I wouldn't expect it to be like that forever.
Right. Here's just a general question. We might have touched on this last time, but do you think the tariffs are a good thing for the economy? And do you think trade policy and all of that, has it been good for the market or not?
I think anybody who has sort of a background in classical liberalism, and therefore has a more libertarian bent or leaning, is probably never that enthusiastic about taxes or tariffs or restrictions of any kind. It's kind of anathema to us, because almost every kind of friction introduced into a free market has a price to be paid somewhere by somebody. And so oftentimes that price is paid by more than one party. So in the case of free trade, in a world where you don't have nefarious actors, we can assume that one place might have better access to both labor and resources to make and produce a certain product, and another place might have similar types of benefits in another product. And these two different countries, if that's what you're dealing with, will benefit from being able to trade in an unencumbered way with one another. And everybody benefits. The producers of these products benefit, and the consumers of these products benefit in that world. It is an idealized world that I just painted, and it's not the one we live in.
Right.
It's not the one we live in because there are nefarious actors. The other thing with this model is that we have to think about not only the things that have happened and are happened, but might happen. And even if you had good actors now, does that mean we always will? An example would be rare earths, right? Even if we have trade policy that makes these things completely accessible to us, China, for example, has a disproportionate amount of rare earth elements. And, if we had a completely unencumbered trade policy, would we benefit from that in the near term? Yes. Does that mean that we should just simply rely on that indefinitely into the future? Well, we can't do that for reasons of national security. So you put those two things together and you recognize that we have this ideal world that we wish we all lived in, and then we have the real world that we actually do live in. And added to that is the fact that we've got some serious fiscal problems, right?
Yeah.
So when I look at the picture of the United States today, would I like to see some additional sources of tax revenue that are not too painful? The answer is yes. Would I like to see us look after our own national security interests? The answer to that is absolutely. And do I think that we need to? I mean, I don't have a fairy tale perspective on China and the United States. China has its own national interests, and they don't agree with ours at all times.
Right.
In fact, actually, I would suggest that we have considerably more exposure than I wish we did. We have massive exposure to Taiwan right now. Even our best chip companies depend heavily, for example, on Taiwan Semi. And we know that Taiwan is in a piece of, it's a piece of a region that China believes that they properly own. And that's not a happy circumstance. Now, I will say also that, there are things that are changing over the course of time. We have quantum coming down the pike at some point that could meaningfully change the game. Peter Thiel backed Substrate recently, and that's going to try to compete with ASML. And so that might create some additional competition and improve chip manufacturing capabilities outside of Taiwan. I hope that's true. But yeah, I mean, it's one of these situations where I think I can appreciate what it is that the current administration is trying to do there. And I believe that some of these things need to be done. I do think we needed to do something vis-a-vis Europe. The trade policy was not fair. It was not grossly unfair, but it was not fair. When they started introducing things like VAT taxes into the calculus, that was absurd. I think that was a negotiating tactic. But the fact is that U.S. cars were subject to import duties in most European countries. They were nothing like what those same countries' automobile exports, for example, to the United States face domestically here. We're talking about, and how big a difference? We're talking about 3 versus 10%, like in that neighborhood. I drive an imported car from, probably not built in England, but it's an English car.
Can we like a Rolls Royce?
I'm not the type to drive a Rolls Royce.
Oh, okay.
You're not gonna see
we'll
me.
Let the audience guess.
I mean, I don't mind saying, and it's I drive a Land Rover. I have a Land Rover Defender.
Okay.
And I've typically, for my daily transportation, I've driven imported cars for most of the last several years. I have drive domestic cars too. Like, I had a Chevy pickup truck, for example, but I had a series of BMWs just because the BMW world made it very easy. I would lease cars from BMW, and they always seem to have very good prices on leases. And they would just contact me and say, bring the old one in and pick up a new one. During the pandemic, I did that. And literally there was nobody at the dealership because I live in California and the whole world shut down out here. But I literally showed up there, never even went into the thing. And they're like, there's your new X5 hybrid, whatever. And I went out with that. But I ended up with the Land Rover Defender. And that one I didn't lease. I bought it.
Okay. Nice.
For the larger cars, and I'm sure a lot of people watching, you think about the tax implications. If you're doing something through a business, leasing can be attractive. But I actually just got annoyed by the fact that the lease would expire, and I had to think about the fact that it was a leased car. And there's accelerated depreciation on some cars that weigh over a certain amount. Land Rovers happen to fall into that category, and I drove one quite by accident, and I don't off-road really, but we go skiing, and I go out into fields for various activities like shooting sports and stuff like that. Take me out into fields and whatnot, and
nice.
So I need something that can do that kind of stuff. I ferry dogs around in the car. Land Rovers seem suitable.
Very nice, yeah. Okay, well, we're getting a lot of questions built up here. So let's talk about MicroStrategy versus Bitcoin. We've got a lot of people hold your MSTY ETF. There's a lot of frustrations around that. Like this comment, I see this a lot in Discord and on the different platforms. I know you don't control the underlying, but what are your thoughts on what's going on, like with strategy and Bitcoin? I was just doing a video on how Bitcoin, it's down, but it's not down that much compared to MicroStrategy, which is down almost.
It's down a lot. It's down a lot today too, actually. We're kind of getting close to a psychologically important number. I was looking at this earlier. We're right around 100,000.
Oh, we are down. Wow, we're like 101.
Yeah, we're down 5% today. This is not inconsequential at all. And people who follow me or have followed me for any length of time will know that Bitcoin has been one of my, on CNBC, for example, they have something called the acronym challenge. And every year you're supposed to put out your best ideas for the year. And for the last several years, Bitcoin was in the list for me. It was this year. You have to make it a cute acronym. So mine was Rising. Right. One of the I's in Rising was for IBIT, which is the ETF that tracks. I wasn't even associated with YieldMax at the time. Now, it's interesting because the weakness in Bitcoin, we'll talk about Bitcoin, and we'll talk about strategy, and then we're going to talk about MSTY. So let's talk about Bitcoin first. It's interesting. The weakness here in Bitcoin started to show itself considerably before, even gold rolled over, right? So gold hit all-time highs weeks after Bitcoin began its descent, which I found to be quite interesting because part of the bullish narrative for both was, monetary debasement, for example. Both were part of a monetary debasement trade. And so what is interesting to me about that is that, that trade seems to have run its course. The reason I believe that Bitcoin might have rolled over a little bit sooner is because one of the other critical supports for gold prices has been that a lot of traditional market participants, institutional market participants like central banks, they have been net acquirers. And then you have other commodity, similar level players that, even as I speak to you, it's going down.
Oh, it's crazy. I haven't even looked because I'm paying attention to so many other things that are down. But when I did the video, it was like 107 from 120. So
this thing could crack 100 while I'm talking to you.
I know. It's crazy.
That's what it's looking like. Anyway, let's leave that alone for just a moment. It's going to do what it's going to do. So, but let's talk about why it's doing it. And also relative to gold. So you have the central bank issue. It was not really, for a while, it wasn't considered important for central banks necessarily to have large gold reserves, but there were other institutional level, national participants in the marketplace that stabilized gold prices relative to other commodities. Saudi Arabia comes notably to mind, right? So when gold prices were low relative to oil prices, Saudi Arabia would typically buy gold, right? So they're a net seller, of course, as the once the first, but now the second largest producer of oil. And when gold prices would rise and oil prices would fall, in the past, they have actually turned the other way. Yeah, it broke 101 Bitcoin just now. I probably shouldn't have that in the corner of my eye. Maybe I'll just I'll just kill that screen so I don't get too distracted. That's not actually the case now. So we do have low oil prices on a real dollar basis, right?
Yeah.
So
they've been staying lower too.
Yeah, oil prices are low and gold prices are high, and Saudi Arabia is not selling gold.
Mm-hmm.
So it seems to me that fundamentally something has shifted in gold where, central banks and nation states have decided that it is going to, just stay in that trade. So I think the debasement trade isn't completely over, but part of it is working a little bit better. And I think that it's interesting because you have the hodlers out there, but it does feel like there are weaker hands in Bitcoin at the moment. That's the interesting thing. So what else is interesting? Well, Strategy's relative performance to Bitcoin is quite interesting.
Exactly. That's where I was going.
So MicroStrategy has been grossly underperforming. We think of Strategy as a levered play on Bitcoin because it is, right? So they had some very creative financing structures, and we would never expect, or we shouldn't expect, Strategy to trade at a discount to the book value for the Bitcoin that they hold. And in fact, because they have some operating flexibility, this is not because of their operating business. I want to make that distinction. Like, I'm not valuing Strategy as a computer consulting business and all. I'm just putting that completely to the side. But I'm just talking about the operating flexibility that they, as a company, have to access the capital markets to make their bullish bets on Bitcoin as they see fit, monetize things like volatility. My view, they should trade at a premium to the book value. That's because in the worst case, you could always just liquidate, throw everybody out and say, okay, enough of you, we'll just take the Bitcoin. Thank you very much. So I find that to be quite interesting. I am rather surprised that the relative value has gotten to the level that it has. I think this is also a technical issue, meaning that I'm not going to really encourage people to plow into Strategy until I see that downtrend reverse. Before I start seeing that bearish sentiment turn into at least something stable on a relative basis, and we haven't seen that yet. But I do believe that ultimately, in the long term, Strategy is going to get its mojo back. I'm not alone in this. This is nothing unique that I'm saying. JP Morgan came out with a very similar comment. I think it was like 2.5 weeks ago. We could probably hunt it down if we wanted to. But this is a volatile asset. Strategy is even more volatile because it's a levered play, and the sentiment is poor. That's just the unhappy reality. So now let's just talk a little bit about MSTY. MSTY's principal driver, as every covered call strategy's driver will be, is 70% the price of the underlying asset. At a high level, that's the way to think about a covered call. 70% of your returns are going to be driven by whatever the underlying asset does. If it's oil, it's going to be oil prices. If it's the S&P, it's going to be the level of the S&P. And if it's MSTY, it's going to be Strategy. And Strategy is down a ton. So let's just take a look and actually put some hard numbers to this, because I think that's more...
because that's where, like I was saying, while Bitcoin has definitely plummeted, Strategy, I think it's almost like 50% since the highs.
It's brutal.
Yeah.
It's I don't I actually was, right before I joined you, I was doing I was having a conversation with my longtime friend, colleague, actually the co-author of the book that I put out in 2016.
Oh, the options book, right?
Yeah, the Options Edge. It was published by Wiley in 2016, and my co-author is Professor Mark Guthner of Rutgers. But we've known each other for a long time. In fact, we've known each other since before he published his first book, which was Quantitative Analytics and Debt Valuation and Management, which is also volatility based. It's published by McGraw-Hill. I'm going to say it was probably around 2010 or so. Strategy's down 45% since mid-July.
Do you have like a screen you want to share, or you just going through? Okay, yeah.
Yeah, I think that's probably helpful.
Yeah.
Let me put that out
I
there.
usually do it, but I remember last time you had some screen.
Is this is it the little plus thing down here at the bottom? Share screen. There we go.
Yep.
Okay, share screen and entire screen. So here we go. So this is so right here we can see this most recent performance. This is just a 12-month price chart. Now, we can do a couple of things here, and I think we should do both. So knowing that July 16th was the high, now let's just take a look at the performance of MicroStrategy, and I'm going to put that as my start date. So 07/16/2025. And let's just take a look at how it has done relative to Bitcoin itself, right?
Yeah.
So you're going to have to bear with me for a second as I do this. I'm going to put MicroStrategy on the left. So I'm going to say, assume you bought strategy. Assume that you bought strategy and you sold Bitcoin. And now I'm going to hit this little normalize button. And that's just going to assume you put $100 into each.
Mm-hmm.
And this is that unhappy result, right? So we have talked about strategy being a levered play on Bitcoin. Normally, you might have thought that it would exhibit perhaps 2 times the volatility and therefore 2 times the returns. And if it had done so, you would expect to be down about 32%, not the 45-ish% that you actually are. This bottom chart that I'm showing you right here is the relative performance of strategy to Bitcoin since the July 16th high. It has underperformed Bitcoin by almost 29%. It's ticking,
Wow.
as you can see right now.
Yep.
At its worst, it was down 34% on a relative basis,
Mm-hmm.
which is, needless to say, a big part of the problem that Misty's experiencing. So now, keeping these the same, I'm now going to put Misty in here. So let's see how Misty did. Now, Misty, because it pays distributions, you see these little tabs. I actually have to put the total returns, of course, because we have to capture the dividends. MicroStrategy doesn't pay dividends, but Misty does. So I have to calculate the total returns for Misty, and we'll go like this. So remember, most of the performance of Misty is going to come from the underpinning stock, and then the rest of its performance is going to come from options. And so this is the performance of Misty since that July 16th date, that that period that we're just looking at. And it has outperformed, but by a modest amount. So it's outperformed by 4.5%. And this goes exactly to the point that I was talking about before. You're in a stock, it's down 12%, and I say, oh, but you did covered calls, so you're down 10.5%. Nobody's happy.
No, it's true.
Strategy's down 45%. You've outperformed by, what did somebody told me? It was my former boss. Former boss from Ivory said to me, because I was running a fund a couple of years ago, and we were outperforming the S&P, and he said, you can't spend outperformance.
Yeah, that's awesome.
And that's true. So it's done better than MicroStrategy, modestly. I mean, I'm not to say that, we experienced only 90% of the losses. That's hardly anything to get excited about. Nobody who's in Misty, and there's nobody with more economic interest tied to Misty than us. Nobody's happy about what strategy's doing. Nobody's happy about what's happening to Bitcoin. We don't like the fact that Bitcoin's underperforming gold. We don't like the fact that strategy is underperforming Bitcoin by a lot. But I will say that, as I pointed out, I remain a long-term Bitcoin bull. And I do believe that strategy is going to regain a portion of its relative valuation. That is, that I believe it's going to be a multiple, not a huge multiple, but that it can trade at, you know, a multiple to the book value of the Bitcoin that they have, a reflection of their, you know, capital markets access and flexibility.
No, I agree with you. Long term, I'm bullish on it too, and that is an important point. Like you said, you're 10% less down than the underlying. You know, that's a flip side of the covered call strategy that rarely gets discussed.
Yeah, I mean, like I said, I'm not crowing about that at all, because it's not a happy circumstance to say, you know, it's not as bad as it otherwise would have been. You know,
right? Yeah, well, they're down 100, we're only down 90.
You know, right. you hit your car hits a tree and you say, it still starts. Like, great. Right. You know, it's not good news. It's just less bad news.
But do you think, so I get it, a big driver is obviously Bitcoin dropping, but do you think the way that, like, I think they're diluting shares and things like that, that's possibly playing
what strategy diluting?
Yeah.
It's so, you know, here's the thing. The way to think about this is, what is the enterprise? A very good point you bring up. How do we think about the valuation of
enterprise value, right,
of strategy? Yeah. And so really the question is, what's the premium that should be paid relative to the book value of the Bitcoin that they hold? And what is the most recent?
Bloomberg, by the way, this is awesome. I'm seeing all the numbers here. I'm geeking out because I studied this in my master's program.
Yeah, you know, I would love to, find a way to ditch the Bloomberg terminal. I've used a Bloomberg terminal since it was actually a terminal. When I first started in the business, it was a dedicated machine that looked like one of the second gen Apple Mac computers. Yeah, like, they would actually, if you got a Bloomberg, they'd bring the hardware, the computer and the thing to you. Wow. And you didn't have an individual login. There was a couple on the desk and people would share them. Now they have Bloomberg Anywhere, so everybody just kind of logs in like this, the way you're seeing. How many Bitcoin exactly do they hold? I should know this off the top of my head. Is like 632,000 something. Hold by.
But I mean, for a system that doesn't always look the most, you know, modern, the information that it aggregates is amazing, I will say.
Well, yeah, I mean, this only tells you part of the story. So one of the reasons that I was looking, this screen right here, I happen to be looking at this in a different context. So some of people watching probably know that Kimberly-Clark made a bid for Kenvue. Kenvue was the spin out from Johnson & Johnson. They sell Motrin, they sell Tylenol, they sell the antiseptic Band-Aid stuff. So not the Band-Aids themselves, but the, you know, like the antiseptic stuff that you can use, Zyrtec, you know, things like this. So that's what Kenvue is. Kimberly-Clark agreed to acquire them. So I just wanted to price out what the deal was. And the deal is that they're going to give them $3.50 in cash for every share of Kenvue, plus 0.1463 shares of Kimberly-Clark. Now, if you look at this thing, I can go over here, and that just refreshed. This is the premium or the discount to the deal price that the Kenvue shares currently reflect. Deal anticipated to close in December 2026. So I can figure out, should I be buying Kenvue, shorting Kimberly-Clark?
Yeah.
As a part of that deal. And what's going on here, if you look in here, you probably can't see it, but maybe you can, this up line. What you're going to see is that there's a little formula that I wrote in here. And I have everything, almost everything that's available in a Bloomberg terminal, I can pull into my own spreadsheets. And I do. I use this thing all day. So it's so hard for people who've used Bloomberg for a long time to move away because it means all your old spreadsheets no longer work. But also it's because if I'm thinking about something, I know how to get it out of this thing pretty easily. Like I wanted to do a comparison in total returns, and I knew that I had to adjust to, like, that kind of stuff becomes second nature after you do it for 20 years.
Right.
And I don't know, you know, I'm an old dog. How quickly am I going to learn FactSet strict? Actually, when I was at Ivory, I had FactSet also. So I used to have CapIQ, FactSet, and Bloomberg. I pretty much only use Bloomberg now.
So the tool on Excel was what again?
Oh, so basically there's something, we abbreviate it, we call it the DAPI. It's the Data API. Okay. Bloomberg has something called BQL, which is the Bloomberg Query Language. and I can use it in a host of other applications, and I can access via a data API all of the stuff that's in Bloomberg. It's actually a little bit more than that, because not only can I pull this data and have the data auto refresh, I can also shovel some of the work process to Bloomberg. So in other words, I can write formulas, ask Bloomberg to do the work, and then spit back the answers into my spreadsheets.
Okay.
So yeah, it's called BQL, it's Bloomberg Query Language. And guys who've been in this business for a long time, we just use this stuff all day, and it's that's why they can charge you $3,000 a month and up. That's what these things cost.
Right.
So I've paid 7 figures. And there have been years when I had one of these things just for my own use because the firm I was with or the work I was doing didn't pay for it. So I've given them more money than I care to admit.
I'm sure. I think when I was in school, it was like 20,000. This was only
the school. Well, the schools get a discount, so nonprofits get a discount on it. Yeah.
Well, that's how I used it, because we had them like in the program. They had them on the campus and stuff.
Yeah, I was touring a campus recently because I have a son who's going to college next year, and Bloomberg actually has labs at some university. So you walk by, I was like, oh, there's the Bloomberg lab, right next to the business school or whatever.
Yeah, awesome. But so we were looking at like price, like the number of Bitcoins versus like the
So, and actually that's probably let's see if they have it in. See where they mention it. They probably have it in here in one of the additional things. So I'll just go over
One of my
here.
favorite things we did in Bloomberg was seeing like all of the like suppliers of a business, seing like all of
it's so cool. Yeah.
Yeah.
They changed that function recently, actually. The way they visualize it now, I'm not 100% enamored, but I'll just show it because it's in the course of our conversation. So pick a company. I don't really care. Why don't you go ahead and pick one? See what other people.
We could actually do. We could do NVIDIA.
So what you can see immediately is everybody they sell to, and everybody they buy from. So this is all their suppliers. This is the cost of goods sold that comes from that company, and the percentage of that company's revenues that NVIDIA represents. So 32.8% of the cost of goods sold for NVIDIA is supplied by Taiwan Semi, and for Taiwan Semi, that represents 13% of their respective revenues. And the biggest single customer is going to be over here. 18.9% of NVIDIA's revenues come from Microsoft. 9.3% come from Meta, and so on. And the beauty of this is, you can then, click on these things and you can go do a supply chain analysis on those companies too, should you choose. So they used to have I've now switched over to Microsoft, so we can now see this one. And we can see, of course, yes, NVIDIA is a big part of their cost of goods sold and who they're shoveling stuff off to. So it's really good. They had a visualization tool that is no longer the default, and they changed it only recently. So it used to have, and this is probably what you were referring to. You would see the company in the center. You see all their competitors on the bottom. You see everybody they sell to on the right and everybody they buy from on the left. And you could click on any one of those. When they make these kinds of changes and refinements, I'm assuming they have a good reason, but I haven't adapted to this one quite as quickly yet. So this one kind of annoys me because I used to love that visualization, and it was all rank sorted. It was really helpful. Yeah. Exactly. So the question we were trying to ask ourselves about strategy was how much Bitcoin they own now. And I thought I saw it was 600. It's over 640,000 now. So let's just use that as our benchmark. So we could just put, and this will sort of illustrate what I'm talking about. If I was going to do something.
I just Googled. I don't know if it's right, but 638,460.
Yeah, that could be right. So this, by the way, so here we'll just put this. All right. So what I'm doing, I just built a spreadsheet. I'm just saying, so you'll see, I just put I happen to know that's the ticker for Bitcoin in Bloomberg. So that's the Bloomberg Bitcoin ticker. You said it's 638,000. I've got a thing here that says it's over 640,000 now. This was updated 2 weeks ago.
Okay.
So let's just put 640,000. Okay. So that's how many we've got. So that means now this is going to tick for me, right? So this is, and I don't need this many decimal places, so we're just going to downsize that a little bit. So now the next question is, what is the value of strategy, formerly MicroStrategy, right? So I know that ticker is this. It's an equity. So we can do the same thing here. I'll just put the last price in here. And then I can either take the last share price, or I can, what I really want to do is account for everything that's on their balance sheet. So I'm going to get the current enterprise value for the business in here. So that's going to be this number. All right. So what we can see, and now I'm going to, this is in millions, right?
Mm-hmm.
So just so that everybody's, I know that, but just so that everybody's visualizing it the same way.
Right.
That divided by that. Oops. Sorry. So now everybody's getting to see down and dirty, kind of like how, when I'm answering questions for myself throughout the day, how I think about it. So that's the current turn on the enterprise value of strategy relative to the book value of the Bitcoin they hold. What's the enterprise value? That's just the value of the business, stripping out cash and debt, like accounting for cash and debt.
Yeah.
Right? So in other words, and people often look at the market cap, not the best way to value a business. It can be okay in some contexts, but that would be looking at, so for anybody who's watching this right now, who's like, why is he bringing up a new term I haven't heard of? If you were looking at the value of a house, you would never look at the value of the house based on how big the mortgage on the house was or how much cash the guy had hidden in the basement. So that's taking all of that out. It's just the value of the house. The enterprise is just the value of the enterprise. So you're getting rid of the issues related to the capital structure of the business. How much debt, how much cash.
Wait. So you said that's a great analogy, but you said the mortgage of the house versus the actual value of the house?
Yeah. So a lot, in other words, if you're looking at, if you were going down the street and you're talking to a realtor and you said, well, how much does that cost? How much is that house worth? How much is that house worth? You want to know how much the house is worth, not how much equity the person who lives there has.
I agree.
Right. So that's really what you're talking about. If the houses in my neighborhood, like the house that's, about 50 feet behind me right here, that house sold for like $3 million. And I don't know whether they have a mortgage on it or not, but let's assume that they have an 80% loan to value. Okay, so that means, they have an 80% loan to value. That means 20% or $600,000 of equity, give or take. The house traded, it's probably a little bit more than that. That house traded hands about 2 years ago. So would you say, well, that house is $700,000? Of course not. I mean, it's a $3 million house just because they have $600,000 in equity. Equity is the market cap of a business. That's what the market capitalization is. And the share price is basically the market cap, divided by the share count. And what you're really interested in is the value of the enterprise, because you can look at two different businesses that have different capital structures that way and compare one to the other. One may have, might be 20% net cash, and another business that's almost identical could have 20% net debt. Mm-hmm. And you don't want to compare the market caps. You want to compare the enterprise value. When you make those adjustments, it'll all come out in the wash. And it's also important for another reason. And this is going to, I'm not trying to take people down a rabbit hole of business school or anything like this, but this is a really important concept for options.
Right.
That rarely gets mentioned. I've always flummoxed by this issue that people don't account for balance sheet leverage when they think about the volatility of the underpinning equity. If you lever a balance sheet, the equity becomes more volatile. Look at Meta, right? Meta is a company that has at no point previously in its history as a publicly traded business had net debt. It does now.
Yeah.
This is a company that always had net cash, right? Now they've got, it's not a lot. It's actually peanuts in the grand scheme of things. So this is going to be updated for the most recently reported quarter, which they just reported last week.
Is that part of the reason why the stock is tanking then?
I think people are so that the company is not expensive.
Yeah.
Right. In fact, I'll go one step further. It's cheap. Okay. They're growing the top line at high teens. So the forecast right now is for the top line to grow at 18% for Meta next year. And the street's looking for about $33.70 a share adjusted. So at $6.30 a share, that means this thing is trading at 18.7 times forward earnings with a bottom line, a net income year-on-year growth rate of about 15%, which probably is double what we expect for the S&P, and it's trading 6 turns cheaper. And why? Wow. It's doing this because everyone's thinking, oh, this is the metaverse all over again. If anybody will remember, Mark Zuckerberg said the metaverse is the next big thing. We're going to invest tons. They did. What did they get? Bupkis.
Well, that's around the same time that NFTs were a thing too.
Yeah. So people think that we're not going to get anything for our investment. Okay. Well, I'm going to just play devil's advocate on that thesis for just a moment and say, let's assume that's true. Let's assume for the sake of argument that this is money down the drain. Okay. Let's assume that Meta can't monetize anything from AI. It's all garbage. It's all nonsense. AI doesn't exist. It's not a real thing. Okay. So they blow $100 billion. Well, $100 billion, this is a $1.6 trillion company, right? So you make a 1-year mistake, you take that out, you're going to make $33.70 a share, and then you say, okay, we screwed up. We're not going to do that anymore. And the thing is, we have seen in the past that when Mark has made strategic decisions that the street didn't like, usually lasted a couple quarters, and then if it really didn't pan out, he said, okay, they had a pivot. Now, the question people need to ask themselves is, do you want to have a corporate management that is trying to do what they believe is in the best long-term interest of the company, or do you want them to respond from one quarter to the next to the whims of whatever shareholders are getting all worked up about at that very moment? In the same way, for example, should traders that are running a fund or running a strategy that has been demonstrated to work over time and has a decent track record, suddenly, because either the stocks they hold have rolled over or volatility dynamics have shifted, should they suddenly say, okay, we're not going to do that. We're going to invent something completely new from whole cloth and throw everything we know out the window? We're not going to do that. So, from my perspective, I think, could Meta suffer a little bit more? Of course it could. This is, in the short term, the markets are a voting machine, as has often been said, and we are below the long-term trend line. If you're seeing my chart right now, right? Yeah. Here's the 200-day. Let me clean this up. I'm going to get rid of the 50 and the 100 just so we're not clouding the issue. We're below the 200-day. Okay. We broke definitively below that. We have done so on a couple occasions in the past. This was macro related. We know that this was sort of that tariff tantrum. But what you want to see, whether it's any of these companies, is you would like really to see a bearish to bullish reversal, just to give us some sense that the sentiment has shifted. This is early days. I actually said this on Fast Money last week, that I think that Meta is probably a buy here. I stand by that. I think that I think people are getting overly panicky about this. If a company starts to see its balance sheet experience leverage because the top line is declining, that the fundamentals of their business are falling apart, that is a reason to leave. But because they're making a conscious business decision to ramp CapEx because they think that's where the business opportunity is, that's a different issue. It could be a mistake. That's not to say that it's not a mistake. We don't know. We will only know with the benefit of hindsight whether this works out or not. But if the cheap valuation because the top line's seeing weakness or margins are coming in, I get that. But that's not the case here.
Well, you said at the high end of the projections, you can even see a case for 3,000 Meta. I heard you say.
Yeah, look, here's the way to think about this. So if you have a 20% year-on-year, let's be really optimistic. Let's say you had 20% year-on-year growth, preserve these margins, right? And what are you actually going to be looking at? You're looking at a company that's trading 16 times, then it's going to be something like 16 times forward numbers, right? And what's the appropriate multiple for that? If you're growing considerably, like 3-4 times faster than the S&P, is 34, 35, 36 times numbers a reasonable? We see Netflix get that kind of multiple, and they're not even achieving that kind of growth rate. So this is the crazy bull case, and maybe not even that crazy, but could they get the same multiple that Walmart gets? Walmart's trading 34.5, 35 times forward.
Right.
All right. So reasonably, you could throw that number on it, and you could say that at that projected growth rate, you're looking at $50. Okay, 35 times 50. What does that get you? It's a much higher stock price than this.
Oh, absolutely.
Right?
Yeah. Mm-hmm.
So again, I think, we have to sort of settle down. The problem is that if people are, what causes more volatility is when, people can't take a step back, and sometimes there are legitimate reasons why they can't. The nature of one's investments and how you use them will impact how much emotion goes into it. If you're managing assets on behalf of your children and your kids are 2 and 3 years old, you're probably not that worried about this.
Right.
If you're managing your assets because every 2 weeks you take money out of your account to pay your rent and your car payment, your feelings about this are going to be markedly different.
Right.
And I can fully appreciate that. They should be too, because your needs are different.
Mm-hmm. Now, going back to our discussion about MicroStrategy, we've had several commenters that are pointing out that basically MSTR would have to get back to about 400 for Misty to hit 20 again. Do you agree with that?
Well, let's see here.
And while we're at it, so there's a lot of good questions coming in here. Another question said, is YieldMax happy with the overall strategy with the single tickers not to implement any noticeable downside protection or any long positions to truly participate in the upside? Was the question.
Okay, let me adjust the second part first, because that's not something that's within our control. That's a regulatory issue.
Okay.
So for single stock covered call ETFs, so you will notice that in other funds, we actually do hold the underlying. This is not a bias that we hold towards synthetics versus common. We don't. Those two, the relationship of those security structures is strictly a function of the carry cost, which is to say that there's a relationship. It's a mathematical one. It has to do with dividends and rates. But in a single stock covered call ETF, these are subject to RIC rules, registered investment company rules. Those are subject to concentration rules. You can't take $1 million in a fund, put $1 million into the stock and sell covered calls on it and be compliant with the 1940 Act. It doesn't work like that.
Mm-hmm.
You can do it if you had, say, 10 different stocks in a fund. That's why Ulti can hold the common. That's why Chippy can hold the common. That's why Biggie can hold the common. LFGY they can hold the common because they won't violate the SEC's concentration rules. But a single stock covered call strategy would. So when you look at this and you're saying, well, why are they doing it with a synthetic? It's simply for compliance. There's not going to be a huge economic difference between the performance of the synthetic and the performance of the underlying equity.
Mm-hmm.
So and what's the exemption to the concentration rules? Cash and equivalents. So you see all of these treasuries that are in here. I'm looking at Misty right now. Those aren't subject because the SEC doesn't view treasuries as risky assets. Now, there's some irony to that, of course, because if you had TLT, for example, the long-term treasury ETF, back when 10-year rates were 65 basis points, I think you would have seen exactly how risky long-term treasuries can be. These are not that. We've got cash and equivalents, short-term treasuries in here. We've got that in synthetic stock. It's going to behave a lot like stock. That's really so. There's nothing really having a material impact on the performance of these funds associated with the use of synthetics versus common. I don't think people should concern themselves about that. What they should concern themselves with, though, what does matter, if you're saying, well, do I want to be in NVIDIA or Misty or Tesla or something else, is that the first order of business is, do I like this stock? Now, we've just talked about the fact that we think that strategy, my own personal view, this is not YieldMax's view, it's not Title's view, it may not be your view. My view is that Bitcoin is still a long-term buy.
Yeah.
And my view is that strategy is going to trade at better than 1.3 to 1.4 times the book value of the underlying Bitcoin that they hold. And they're going to continue to acquire it, and they're going to avail themselves of the capital markets to basically create accretive transactions to acquire more Bitcoin on behalf of Strategy shareholders. Do I think that's going to happen tomorrow or next week? Well, technically, that's not. I mean, it would be foolish for me to say so because it hasn't exhibited anything to let me believe that that's the case. Right now, it's underperforming. Technically, it's in a bearish pattern. That's the reality. So I don't think that there's anything fundamentally wrong with covered calls. Covered calls are a time-tested strategy that has existed for a long time, and it tends to outperform in some markets and underperform in others. But I will say this. I think that covered calls are a better place to be in the current market regime than they have been in a while. Let me tell you 3 reasons why. The first is this. That is that the value of a call is a function not only of the volatility of the underlying asset and the implied volatility that the market assigns to the options, but also rates. So the higher rates are, the higher the forward is for the stock. Now, in theory, this should all work out. And, you would imagine that there's no arbitrage there. But what actually has happened was that as we were in a bull market for bonds, a multi-decade bull market for bonds, and as rates fell, it compressed volatility, it raised valuations. It actually increased the turn that you apply to equities. If you're wondering why that's the case, think about it this way. There should be a relationship between the returns of all assets relative to one another. As the risk-free rate falls, the amount of returns that investors demand from competing assets will also fall. The corporate earnings yield is just the PE upside down. So if the S&P has a PE of 20, 1 over 20 is 5%. That is the earnings yield you are getting from owning equities. So it also reduced the cost of capital for companies so they could grow at a faster rate. So you put all of these things together, it created massive acceleration in equity prices and at the same time compressed volatility. So covered calls became less attractive. We have reversed a 40-year bull market for bonds, and I think that that's going to create, on a relative basis, better performance for covered calls in the years ahead. Because I don't think we're going back to zero interest rate policy for anybody wondering what I'm babbling about. I don't think we're going back to that.
5, maybe below 5. That would be awesome.
Yeah, I mean, look, we don't want high rates because that's indicative of certain problems. We're really looking for kind of a sweet spot. I don't think we're that far off of it, to be honest.
I just mean
I do wish that PCE and CPI were getting down to a lower level. I wish 2% was a ceiling, not a floor for inflation. We're not, right now that seems where we're at, though, unfortunately.
Yeah, I didn't necessarily mean the Fed funds rate, but if we could see mortgage rates like 4 or 5%, that would even be good.
That would be very nice. Right now we have a disconnect. Two things the home prices. So median home to median income is at historic highs. One of the reasons for that was because we had historically the lowest mortgage rates in history. So we had a home shortage. We had a big influx of migration. However you feel about that, I hear people say things like, "Oh, well, we need this because there's a disproportionate portion of the labor force for home builders are immigrants." This is not actually borne out by the math. People can do their own homework on this if they wish. There's an average of 2.5 people per household for within the United States. That's true for immigrants, legal or illegal as well. The fact is we have not imported enough people to make up the housing demand that they have created. So that's a false narrative, just drives me crazy because people just don't bother to do any homework and look at the actual numbers.
I get the economic concept of supply and demand, because I've heard the solution to high housing prices is more supply. I mean, that does make sense theoretically, but some areas I just don't think are ever going to come down unless we have a crash.
Well, I mean, it's interesting, right? So we have a dynamic. We're about to test this theory effective today. Today's an interesting day because it's an election day around in a lot of parts of the country.
Right.
The mayoral election in New York, where I lived at one time, both my kids were born in New York City on East 68th Street. My wife actually, she was in labor. We walked to the hospital from our apartment.
Oh, wow.
It looks like Zohran Mamdani is going to win the election, and this is an interesting situation because some of his policy prescriptions don't satisfy some sort of fundamental economics for improving housing costs at a high level. You need more supply and you need reduced demand. If you start artificially constraining prices, you actually hurt both sides of that equation. And you end up with a bigger housing shortage. And what ultimately ends up happening is you have haves and have-nots. And what I mean by that in this case is not the typical haves and have-nots. We think of, oh, you have $1 billion. You can buy an apartment like Ken Griffin did on Central Park South. Isn't that nice for you? I'm not talking about that. What I'm talking about instead is that you end up with people who are lucky enough to get favored housing prices, like rent-controlled apartments, and then you got everybody else. And that's a big mess. You need people building new housing stock, and you need people who don't need it to have economic incentives to leave. So if you have somebody who's 75 years old and is staying in their apartment because they're paying $216.50 a month for something that would be going for $21.50 a month, $2,150 under normal circumstances, you just totally screwed things up. There's somebody who probably should be someplace else. That's a problem. And you have somebody who needs to be there who has no place to go. It's going to play out in real time. It's not just an issue of theory. I mean, it's a lab experiment that's been tried in the past. It has failed in the past. It'll fail this time, and we're going to get to see it.
Yeah. So your favorite topic, NAV erosion, which is, I know, not the correct term, but like we've seen a lot of jokes about can we create like some like NAVMax products to like maximize the NAV?
Target 25s, and actually we have them anyway. I mean, Biggie and Chippy have illustrated that we have funds that do this. I had a video that I did with Jeffrey Patek. He's a senior managing director at Morningstar. He's not a friend of mine. I would barely, I'd say we're acquainted with one another.
Yeah.
We've had several conversations. We obviously have a very different opinion on a couple key things. Would we like to see the NAV be stable and rising? Of course we would. One of my favorite charts in the world is this one for Biggie, because Biggie has behaved much like the S&P. It has handed out distributions. The total returns are illustrated in orange, and the NAV is illustrated in white. So over the course of the last...
I'm a fan of Biggie, by the way. Me and Max Convexity were just talking about this the other day. He said, oh, if they do that, they're not going to have as much AUM. But no, I mean, I might be in the minority, but I think funds like these are great.
I mean, this outperforms our competitors. It's a lot better than JEPI, for example.
Right.
It's better than the S&P.
Yeah.
I mean it has outperformed on a total return basis if you reinvested. And I don't know what else to say. It actually had a smaller drawdown as well than the S&P did. So, you can have it. I mean, if you really hit it out of the park, and what I mean by that is hitting it out of the park means that you got the sweet pitch right down the middle and you were lucky enough to hit it with everything you had. That's what Chippy is. Chippy, I'm not making the case that, Chippy, because it returned close to 60% on dividends reinvested just since April, and 53% or so had you taken those dividends and put them into cash. And, I mean, the share price is 26.5% higher, and you took out all of those distributions marked out in blue. Now, this is because the underlying assets of Chippy are crushing it, right?
Yeah. Yep.
Biggie, there's no real stock picking going on in Biggie. Biggie is just, it's like taking the top 10% of the S&P. Effectively what you're doing. You're saying, okay, here are the biggest companies. We're going to weight those. And by the way, that's an approach that is used in other contexts in finance all the time. Dispersion traders use the top 50 all the time.
Right.
So it's a good S&P proxy. Take a look at what's in Chippy and you say, oh, how did it do so well? Well, I mean, look what's in it. It's just basically, one home run after another. So of course it's done very well. So I'm not trying to hold this out and like say, oh, look at Chippy, we're geniuses. What I'm saying is that when you look at the performance of these funds, The single stock covered call funds, like I said, they're largely a function of the performance of the underlying stock. So if you like Tesla, choose that. If you like Palantir, choose that. Alex Karp he's been blanketing the airwaves. I know he's not happy about how Palantir behaved relative to their earnings results, which they just announced. I find that very interesting. The thing's trading 110 times revenues, folks.
Yeah, for real.
It's like, yeah, you don't get to complain about how the market's mistreating you and the short, those evil, bad short sellers are out there lambasting your stock when you trade at 110 times revenues. That isn't something to complain about on this planet or any other.
Yeah.
But, this is, the performance of these things is going to be a function of that. We obviously have demonstrated in funds like the Target 12s, like in Chippy. And I think the Target 25s are going to be very attractive for this reason. The one thing you have to remember, and everybody needs to bear in mind, is that when you have a registered investment company, registered investment companies are compelled to distribute 90% or more of all of the income that they generate, which is the short-term capital gains realized, not unrealized, but realized. That goes into the ROC calculation and things like that. And the premium that you collect. Now, you can modify a strategy such that you make it less likely that you encounter something that is going to have to be distributed for tax reasons. Because remember, this is the important thing. If you don't distribute, there's a penalty. That penalty is a 30% corporate income tax. You don't want that to happen. So that means when it goes up, you have to distribute the capital gains. And when it goes down, you have to give them the income from the covered call that you just collected. It's very difficult to maintain NAV stability when you have to do that. So you have to focus on total returns. Now, in MicroStrategy's case, the total returns have not been positive since strategy hit its highs on July 16th, as we previously showed, because that's the largest driver. But in a diversified fund, you're probably going to be less subject to the vagaries of, what we call idiosyncratic risk. Idiosyncratic risk is the risk associated with an individual underlying stock.
So you answered another question with that. And I don't think I've ever actually heard that stated, but that's very interesting that you're obligated by the rules to pay out, what did you say, 90% of what you...
90% or more. If you don't do that, so if you buy so leave our funds out of it.
Yeah.
And just look at the real estate fund. So this is something I would talk to Jeffrey Patek about. And this is the reason I brought up his name, because I think I legitimately think he's a thoughtful guy, and I think he's a genuine person. I think he really believes the things he's saying. But it is possible for people who believe different things to both believe the things they're saying, and I think that's true here. I don't think he's given enough consideration, frankly, to that dynamic. You need to manipulate the strategy a little bit in order to stabilize NAV, but you then end up hurting the frequency of distributions or the amount of distribution. So it's a balance to be struck. And look, I get it. Nobody wants to see a price chart that goes down. It's the first thing everybody looks at. Everybody who knows me knows I focus mostly on fundamentals. And still, what's the first thing I look at? You mentioned a stock I haven't looked at. I looked at the price chart. Everybody does, because it's the first thing that pops up when you put a ticker into any system you use.
Right.
So I get it. And, there's active conversations about it. Like, what does one do to stabilize NAV and pay these distributions? There's another issue, too, which can, come up, which is also Rick rule related, where there's a confluence of factors that happen. MSTY last year was a good example of this. And I was, again, not associated with Tidal. I wasn't associated with YieldMax last year. But I've operated ETFs. I've lived in this world for a while.
Yeah.
So strategy, Bitcoin rallied very sharply at the end of 2024. Strategy followed suit, and MSTY followed suit.
Oh, it was great. The end. I hope we could have the same end this year that we did last year. That would be amazing.
Yeah, that rally started a little earlier than we're in right now. I think we started to get a real Bitcoin rally. Was it October-ish? I'm going by memory now.
I want to say after the election, the market, everything just shot up. I mean,
there was a risk on. There was definitely a risk on response, just like there was when Trump won in 2016.
Yeah,
there was a blip overnight in the futures, and then it was off to the races. I think we're like up
that day,
12%.
the futures were down like 700 because it was such a shock outcome by the opening of the market. The market
I was
closed
surprised
that day. Yeah.
I believed the pollsters up until that day.
Right.
You know, when that result came out, I was like, okay, these polls are not for whatever reason. Like, we can come up with theories or hypotheses, I should say. People always say conspiracy theory. A theory is backed by facts. So a theory, the term theory gets thrown around way too liberally, I think. But you could have a conjecture, you could have a hypothesis. Mine was that I think people don't answer these things honestly. But the truth is, it no longer mattered. What I realized was that these things they cannot be relied upon the way we thought they could.
Right.
And because of that, I'm not going to rely on them in the future. And there was a lot of stuff going on in the polls before the most recent election in 2024, including one that had Harris leading in Iowa by 5 points.
Oh, that was crazy. I think the pollster got fired. Yeah.
And I remember, if it was 2016, I would have said, oh, wow, what's going on? I mean, is that the tip of an iceberg? Is there a big sea shift?
Yeah.
That's what I would have thought in 2016. What did I think in 2024? I was like, that's garbage.
Yeah.
That's obviously garbage.
And the pollster got fired. But, and not to get political, I have noticed in general, like Republican candidates do tend to outperform the polls for whatever reason. But yeah,
I mean, maybe older voters, which they tend to have more support amongst, show up more. Yeah, that could be a reason. Maybe people aren't honest about who they support when somebody out of the blue calls them on the phone and says, I live in Mill Valley, California, home of the Grateful Dead. Basically, I can see downtown San Francisco from my front door. I think that there is definitely some perception around here that people feel restricted about the things they could say. I don't really feel that restriction because I have been a registered independent my entire voting life.
Yeah.
I have worked vaguely as a volunteer in politics. It was usually for Democrats, admittedly. I had my college roommate worked in the Clinton administration. Yeah. I did volunteer advance work for Vice President Al Gore when he resigned from the Harvard Board of Overseers back in the day.
Oh, wow.
Democrats were a different breed, though, back then than they are today.
True.
I don't really understand completely what has happened to people's policy positions, because the policy positions that were promoted by the people I just mentioned, by the Clinton administration, I'm still very close friends with the people that worked in that administration. Their policies haven't changed.
Right.
Mine haven't changed.
Right.
The world seems to have changed around us. I'm having a hard time understanding the rationale for some of the things that have happened. But look, people bite their tongue sometimes because you just want to get along. No one wants to start a fight. So you tell people what they want to hear, but then you go to the polls and you do what you think you ought to for the betterment of the country.
Yeah. Now, at this point here, I see this a lot. It says, so in his opinion, the problem is YieldMax has way too many funds, expanded too fast, probably should have stopped at some point on big names, watch performance pivot to these target 25 ETFs.
Yeah, that's no. People say that, but there's a couple of things. I'll address a couple of things I've heard more than once. So one is they've adopted too many funds. What people don't realize is that the trading staff has grown at almost the exact same pace.
I was just going to ask that, because I asked another fund manager, does it impact you at all when you add more funds? You said the trading staff has grown. So
it's grown. I mean, not only has it grown substantially, but actually, so if you can imagine, it means that there's more dedicated resources for individual securities than there was, because like I said, it's every morning I sign on to the trading meeting, and it's 2 pages of faces. It's like the Brady Bunch window times 4 or 5. There's a lot of people who are working on this, and the thing is, they don't change what they're doing because of it, right? So I'll take a look right now just to give some perspective.
Now, what you're doing,
I just realized I have to hide that screen because I was about to show something that I can't show publicly.
Okay.
It was trading related. I was going to pull up one of my trading screens. I was like, I better not do that.
Well, speaking of that, someone asked you like what your options picks are for the next 30 to 60 days. I don't know if you can answer that or not. Are you restricted, by the way, because you work for YieldMax? That's another question that came up.
So, well, obviously, one of the things that, and this is true for me, whether you're on the sell side, the buy side, doesn't matter. There are conflict of interest issues that always apply. So the policies and procedures of almost every regulated entity on Wall Street does not permit the people who work in these firms to say or do things that are, one, in our case, not in the fiduciary best interest of the shareholders that are invested in the funds. So we are a registered investment advisor. That means we have a fiduciary responsibility, which means we are subject to things like the prudent man rule. We can only do things that we believe are in the best interest of the shareholders. The sell side, by the way, it's a slightly different rule set that applies. It's not as rigorous. So a broker doesn't have the same rule set as a money manager. But that makes some sense, right? They can't do anything to defraud. But on the other hand, they are selling something. They are securities brokers. They're selling stocks. So it's a little bit like saying, should you go for advice about the best way to spend money on cars to a new car dealership, right? Well, they can't defraud you, but they're in the business of selling cars. So you can't hold them to the same standard as you hold your accountant or your lawyer or other people who advise you. So we are held to a fiduciary responsibility in the fund. It is plain and simple. This idea that the number of funds proliferated too quickly. Understand this. When you have covered call, single stock covered call funds, those are designed to be constituents of a portfolio. You want a lot of them. It does not hurt us in any way to have a bunch of those because we follow a very systematic process and we have a lot of people doing it.
Yeah.
And there was something else I saw, a comment somebody made on Twitter, and I saw it and I actually laughed out loud when I saw it. And I thought, this is a person who does not know anything about trading and has never done it professionally to say something like that. And the comment I saw was, they become lazy. And you can see that in the performance. And I thought, boy, you've never lived on a trading desk. You've never been on a trading floor. To say a comment like that, you don't know what it is.
Fair.
There is no
Yeah.
And think about this.
Yeah.
There's nobody watching who has watched their P&L turn red who then got lazy.
Right. No, I get that. But
that's like inane. Yeah. It's just
I get it.
Give me proof you live in your mother's basement.
Like, I'm with you 100%. But like,
I was like, because that's not how traders work.
No,
I will say bad things happen though. So take the performance of funds that are not doing as well as we would hope. You haven't brought it up, and don't feel like you need to, pull punches. But I wish some of these funds were doing better.
Me too.
And what is the worst thing that a trader could do? The worst thing a trader can do is if you have a process, you have a team, and you have a strategy, and performance starts to flag. Number one, what you should do is what we call performance attribution. You go and you dissect everything. And it's funny because in another one of my screens, I'm doing exactly that for Alti. So you go through and you look at every transaction and say, okay, what was going on? Did this follow the process? What worked and what didn't? Why did it work? Why didn't it? And did at any point we violate our investment process? So that's the first thing. When I see people say like, oh, you got to change the strategy. Well, that's what bad traders do. Bad traders, you come up with an investment process, you try to apply it with discipline and rigor, and then all of a sudden when something goes south, you just throw everything out the window and start doing random stuff. Nuh-uh. That is not, there's nobody who does that who lives long on Wall Street, I promise you.
Right.
On the other hand, it does not mean that you don't question everything you do, but again, you have to do it with similar discipline and rigor, which means that you have to test everything. And that does take some time. So does it mean we're not evaluating how we can take every fund? Believe me, there's been no less work done because there are more funds. We have a staff that can handle it. There's actually more people now than there ever were. We're adding all the time. Many of these people have worked together in many cases for decades prior, in a prior life. I mean, a lot of people who are watching this probably know who Scott Snyder is. He's, basically running the trading team, and Jay Pastorcelli, obviously, but Scott is the one who leads the trading calls every morning. And he has worked with a lot of these people for a long time. He's been at this longer than I have. And I started in the mid 90s. So, this is not his first rodeo. It's not even his 10th. Like, he's been doing this every day for decades. You don't need, it's not the number of funds. You need to have as many covered calls as you can, because those are the chess pieces that you're putting onto the board, right? So when you're assembling a portfolio, you need a lot of those. It is not a challenge for us to accommodate that. I just took a look. We had 797 trades today. That's what the lazy traders are doing today. 797 individual orders, trading 8 to 9 million contracts a week. When things don't go well, it increases the work, not because somebody's coming down from on high saying, hey, you guys need to, cracking the whip, saying you need to work harder. When things don't go well, that's what traders do. They start trying to look at everything. What can we be doing better at all times? One of the things that they shouldn't be doing is probably taking advice from, trolls on social media. That's not a good approach when you're running 20 billion bucks.
Well, I think there's a couple things going on there. So one thing, and this, and I'm on the same page with you, but the bulk, I think, of the significant portion of the audience for these retail funds are retail investors, which tend to be, what we're discussing. And I think that
most of them are probably not that. I think most people are reasonable people. In every walk of life, I think that's true.
Yeah.
People get very emotional about their investments. They should, because you need to watch them. It's important.
I'm just going.
Nobody likes losing money.
I go by different comments I get and what I see. I mean, I get, because I'm on all the socials too. I get, where, like somebody said, oh, they just got lazy. Like there's a lot of, like you said, conspiracy theories.
So,
yeah. Other things. So trading staff has grown. We never see Jay anymore. Is he just strictly trading now?
So, Jay is on every trading call. I mean, I will tell you that one of the things that he had increasingly become concerned about was that how do you preserve an atmosphere of transparency where you always have somebody available to talk to anybody who would like to hear from us or talk about what we're doing.
Yeah.
And still, his position on the trading and investment side is unique. And that is to say that you can have a lot of traders executing things, but when it comes down to the strategy construction and making sure that it's being implemented, that's going to be a narrower group of people that do that. You don't just hire a trader and say, oh, here's a fund, have a ball. That's not how that works. So in his case, it was creating quite a significant demand on his time to participate, and he didn't want to have less access, essentially, to YieldMax. That's actually how this happened. I was talking about one of the YieldMax funds, much like we're talking about it now, and they called me up afterwards and said, hey, we need somebody who can come in here and talk about these things. And it can't always be Jay who does it. And I said, yeah, I'm happy to fill in and help out in that respect. I'm also happy to have conversations with the trading team and the portfolio managers, if they wish, on my own views from my experience trading, from my experience as a portfolio manager. To do that, part of that also is going to involve me doing a little bit of due diligence of my own. So I'll do my own performance attribution calculations, which is what I'm working on.
Yeah,
and
that's awesome.
we'll discuss that and say, based on my experience and my analysis, because this is not, again, thumb in the wind stuff. Let me give a more specific example. When, if, and how should one adjust roll hedges on equities, right? What is the ideal or optimal time to do that? Now, in situations where, because remember when I was earlier talking about how when you have highly volatile intraday periods, or day-to-day periods relative to the week-to-week, month-to-month. And by the way, for people who are interested, this is an academic area all its own in the options world. Bruno DePire, I think, has done some really great work on this. He's the head quant at Bloomberg, as it happens. These are issues about how you basically affect a trading strategy as the day progresses and from one day to the next. And should you scale and roll those trades more aggressively or less aggressively, or in tranches? And so basically, we're going to be evaluating, what I'm personally evaluating is how those things can be optimized. Because when a market starts to move, let me give you a really simple example. I was actually talking to another trader about this earlier today. Optimizing an options trade is not simply about saying, well, if you go back in time and had you done this, it would have turned out better. Because you actually have to go back in time and establish whether or not you correctly evaluated all of the possible outcomes and assigned them a reasonable probability at the time. And why is this important? Because let's imagine that I had a strategy that went back 10 years, and that strategy was I was going to buy call options on NVIDIA. Would have been a great trade, right? Because NVIDIA has gone substantially higher. Now, let's say I was only going to buy a fixed quantity of them. And what I could do is I could either buy a call option and hold it forever, a 10-year call option, or as an alternative, I could buy that and periodically roll that option up and out. Well, the interesting thing is that with the benefit of hindsight, knowing that the quantity would be fixed, the answer is that the best result would have been buy, hold, set, forget, never even think, because NVIDIA rose 80,000%. That's the actual number, right? Up 80,000% NVIDIA. So rolling a fixed quantity wouldn't have helped. It only would have hurt. We know that with the benefit of hindsight. You can only come up with an appropriate trading and investment strategy if the approach involves taking all the things that are knowable at the time and then backing out what that strategy should be. Not saying what would have been best, because that's what's called curve fitting. It's a really bad habit in trading. Don't do it.
Yeah.
Whenever somebody shows you investment results and they just seem just too remarkable, and they say, I came up with a timing tool. And in this timing tool, I look here. So I came up with this signal and it said, sell the S&P here, buy it here, sell here, buy here. And the results are always phenomenal. No one's ever seen a bad back test because of curve fitting, because you establish the rules with the benefit of hindsight. You have to take out what's called out of sample data and apply the rule set to that.
Right.
And that's what we're in the process of doing. Optimization, out of sample, and so on. That's the iterative process you have to take. It's the only approach that can be done.
Fair question here. Do you anticipate Ulti to continue to pay 85% for the next 3 to 5 years, irrespective of the NAV? This person says with 28,000 shares, they have very vested interest in this.
Yeah, you do.
Yeah.
You do have a vested interest. So the payout rates for these things are going to be, so the payout rate is dependent really on implied volatilities. The total return is going to be a function of volatilities and the behavior of the underlying asset, but the rates are more implied volatility dependent. I do not expect implied volatilities to collapse to like 2017 levels, maybe ever again. Maybe not my professional life anyway. Could it happen in 50 years? Maybe. But I don't think that's going to happen. Anybody who doesn't remember, that was a period of exceptionally low realized and implied volatility.
The market just went straight up that year.
It was unbelievable. And it led into something called Volmageddon.
Right. Next year.
Yeah.
Yeah.
So it's interesting. Another friend of mine from the business, a guy named Christopher Cole, he runs a hedge fund called Artemis. We were at the SIBO Risk Management Conference in 2017, and he was talking about some of the exchange traded products that were shorting volatility, and he discussed specifically that these were serpents eating their own tails. and that he expected a blow up of epic proportions. And it was a really memorable conversation because he was on the stage with a couple other people who were saying volatility is going to come back, and when it does, it's going to bite people badly who are in those types of strategies. And the fund managers of that ETP were in the audience, and they stood up and they were going back and forth.
Mm-hmm.
And that ETP blew up the following January, February of 2018. The things, they just completely blew up because they were heavily levered, short VIX, and it was just a disaster.
Right.
And I really was hoping that at the next SIBO RMC that both participants would be there. Of course, the guys that were running the fund were nowhere to be seen, and Chris wasn't on stage, but it would have been interesting had they been, because I would have liked to have seen the follow-up to that earlier conversation. We're not going back there. We're not going back to DECE of 2017. So what that means is that for the purposes of funds, ours or anybody else's that sell vol, no one's selling vol down to 6 in the S&P. It's not going to happen. It happened in one other previous context, by the way, that actually goes back further in time. It was Nick Leeson.
Mm-hmm.
So on the CYMEX, I applied for a job as an options trader on the CYMEX many, many years ago. I would have been down there if I'd gotten that job. I'd have been facing off against Nick Leeson. It was one of the epic things that I missed out on. If I'd gotten that gig, that would have been awesome.
I think you would have been really good at it. Yeah.
Well, I did floor trade. I just didn't trade on that floor.
Yeah.
And it would have been a tale like no other to tell how I watched bearings come apart because somebody sold 4 vol in Nikkei, which is what he did.
Wow. Okay. He's been asking different variations of this throughout the live stream. He said, is it a single stock flood strategy? How does Roundhill solve this? I think this is very important because, Roundhill, not to name drop a competitor, but they have this like leverage thing now with what is it? WPay.
Yeah.
Roundhill and Rex shares compared to YieldMax side by side, they outperform almost all the time. True or false is what he says.
Okay. So very different products. I'm acquainted with 2 of the partners at Roundhill. One of them actually lives in my town. I live on the West Coast, by the way.
Did he buy that house that you were talking about was for sale? I'm kidding.
No, I think I think he lives in a ritzier neighborhood than I do.
Oh yeah.
I think the houses are closer to $8-9 million where he is.
Oh yeah.
In any case, this is California. Prices are stupid. Right?
I know.
$3 million is actually cheap out here, believe it or not. I think the average home price in this town is like 5.6 or 6, something like that. And this is not the expensive area of Northern California. That's Atherton, where it really gets crazy. In any case, which is down by San Jose for people who don't know it. I think it's the richest zip code in the country. Anyway, so there's a couple things I would say. Covered calls are a decent strategy. Full stop. Right? It's an investment strategy that's time tested and proven. So let's put that to the side. That's what the covered call strategies at YieldMax do.
Mm-hmm.
I don't disparage other people's strategies, so I'm not going to disparage YieldMax, Roundhill strategy. But the levered products are a different product. So 2 things about that. The first is that leverage cuts both ways, which is that if you're going to get 125% or 120% of the upside in an equity, that's great when stocks are going up, and it's not going to be when they go down. The second thing is that it's not a covered call strategy that they implement in all of their funds necessarily. So remember what I described about funds that distribute. Let me give you an example of how one could create a fund that distributes high yield and has an interesting return characteristic in a rising market. Let's just make it the S&P. And I say, I'm going to create a total return swap that delivers 125% of the S&P returns every month. Okay. And when it wins, I'm going to distribute that back to the shareholder. All right. So if the fund is up if the S&P is up 1%, my product's up 1.25%. And I distribute 1.25%, and we move on to the next month again. And we continue to do that. It's going to have a very attractive characteristic in a rising market, right? Because I'm going to be delivering better than market returns. So that's quite sexy. It's not the same as a covered call, though. Is there something wrong with it? Not necessarily. I mean, is there something wrong with using margin? No, I think margin has its time and its place. Even more, and they're not even using full Reg T margin, right? That's 2 to 1. They're certainly not using customer portfolio margin, which could be, 15% equity, right? And you get like 5 to 1 leverage or something like that. So I'm not opposed to it necessarily, but people need to understand what they're getting. And if you back out what the strategy is, then you're going to compare it like for like instead of looking at it relative to a covered call. You're going to look at it like levered equity, which is what it is. It's not apples to apples. And I know that some people, Mike Venuto might be in this category. He really takes issue with being compared to a product that is not at all the same thing. He's saying you're taking leverage and then handing out the benefits of having deployed it when markets are rising. And I don't like having a covered call compared to that. Okay, I get that. They're different products. They generate their returns in a very different way. What they have in common is that they make big distributions of, whatever returns they have. And so I think that's why they get put into the same bucket, but they don't deserve to be.
And that makes sense. And again, I'll go back to, retail, I think, is new to this whole palette of, high yield products. And I can understand why there's going to be misconceptions like that. I think how do we educate better? Maybe simplify things. I see a lot of people say, have been saying that. How do we educate the followers better? I guess.
Yeah, I think the most important thing is if you look at a product, and I come back to something like Biggie, because the nice thing about Biggie is it gives you an underpinning basket of stocks that everybody knows. It behaves like the S&P, right? So if you use that to evaluate the quality of a strategy, what do you have? In that thing, you have S&P-like returns, actually slightly better, net of fees. You can reinvest those dividends or not as you see fit. Similar volatility characteristics, similar drawdowns to equities. So you get a direct side-by-side of the benefits of covered calls or not. A covered call doesn't always outperform. When a stock rockets, it's going to underperform. When it sort of trundles along, it's going to outperform. And when it goes down, it's going to outperform, but your funds aren't going to do well, right? Because the assets are falling. So it's a situation where it outperforms in one scenario, it's less bad in another, the down scenario, and it underperforms in the up sharply scenario. The roundhill funds, which are levered, that's not the same set of dynamics, right? They outperform on an up scenario. They're actually going to underperform potentially on a standstill basis just because there's a little bit of bleed associated, and they'll underperform in a down scenario because of the leverage. So, there is that. But again, just know what you have. I think look at things like Biggie and Chippy to evaluate the strategy, pick your stocks carefully, manage risk. These are all, I'm not telling anybody anything novel that they don't already know. Or if you don't know that, manage your risk. That's always good advice.
For sure. Can you speak to LivestreamX at all? I remember that was discussed when we were in New York. And any possible updates or anything on that?
What I can, it's interesting because when I met you in New York, I actually could say whatever the heck I wanted at the time because I was not formally affiliated. Now, I am restricted on anything I can say to what is publicly disclosed. So I can delve into issues that are out there. It's out there now that Target 25s are a thing, right? And that's likely going to be coming out. So I can talk about that. I could talk about the weeklies. There are conversations going on about other issues, which are probably going to become public as well. But anything that hasn't been publicly disclosed, where there hasn't been a formal filing, unfortunately, I can't say, oh, here's what we're talking about behind closed doors. I would love to say, hey, I got some inside intel for you, but unfortunately, I can't do that.
Yeah. Okay. Let's see. We're a lot of talking about blocks here. Yeah. Thanks for taking that question about, the competitors and stuff. Downside protection. So some of them do puts, like also, like not to name drop other competitors. I'll try not to, but
I don't care.
Well, like yield boost. They're doing like a kind of a multi-leg strategy. Like they're doing puts in addition to like their leveraged ETFs, right? So I don't know if
we use puts in Alti, and actually, when volatility ticked up a little bit more recently, Scott and the team started using put spreads to mitigate the downside cost a little bit. I am personally, particularly when skew steepens, this is a strategy I rather like, because otherwise it's very difficult to have a positive carry and also have insurance and not have grossly asymmetric risk-reward relationships. So when you have a put spread, the nice thing about that is that you're buying a closer to at-the-money put and selling a higher implied volatility out of the money put. And that's a dynamic that can also play in your favor when you're selling call spreads. So depending on the steepness of the skew, for anybody who doesn't know, I'm not trying to get all wonky. It's a pretty simple concept. Implied volatility is not constant for all options. Not as you go in and out of time. So like short dated options don't always have the same implied volatility as longer dated ones, but the same is also true for moneyness. Out of the money calls versus out of the money puts versus at the money options. For most equities, it is common for out of the money puts, and it is definitely true for indexes. So like the S&P, the NASDAQ, and so on. Out of the money puts have a higher implied volatility than out of the money calls by a similar percentage. 5% out of the money call option on the S&P will have a lower implied volatility than a 5% out of the money put will, all else equal. When you start using put spreads and you're buying a closer to at the money option and buying and selling a further out of the money put option, you get to take advantage of that dynamic. And on the call side, you may or may not, depending on the shape of the vol surface. And that can actually create reasonably attractive risk-reward relationships around spot. When you have really wild moves one way or the other, things get a little bit different. But as a general rule, that's going to be true. And so, whether it's our competitors or what we're doing, to the degree that there's discretion, Alti has more discretion. They are affecting spreads now on the put side as well as the call side, more commonly because of the slight uptick in vol. And, that's just being responsive to the market conditions then prevailing.
Right. All right. Well, I think that's going to wrap it up. Thanks so much again for coming on. Any last words or comments for the audience?
I appreciate the fact that folks are asking these questions and coming back for this. And I recognize that, when we do this, because we do fall down rabbit holes a little bit, that sometimes we end up talking more about a topic that doesn't interest you. And maybe we didn't get to the thing that did interest you, not any conscious decision to avoid those topics. I hope you have me back and we can get to those. And
of course,
I realize I can be pretty worried about things. A lot of this stuff, if you haven't figured it out, I love talking about this stuff. Right?
Oh yeah.
This is not just my vocation; it's my avocation too. And
Nice.
Because of that, I enjoy these conversations. But I also know that means that some of your questions probably went unanswered. I still want to answer those, and hopefully I'll get another chance. And I appreciate the invitation.
Absolutely. Yeah, we'll have you on. I mean, we used to have Jay on like a lot, but we'll keep having you on, of course.
He, by the way, he's not out of the loop completely, but
Yeah.
I mean, he's been crazy busy. I mean, he's also traveling a lot. He's had board meetings in New York. So the last 2 times I've talked to him was as he was getting on a plane. So
wow.
he runs around like a maniac, and I don't know how much sleep the guy gets.
Wow.
I mean,
yeah.
But I'm sure he'll be back on too when he has availability. I'm sure.
Oh, for sure. Yeah, and you'll be a regular guest, of course. I mean, YieldMax. It started with YieldMax for me, like as far as high yield. So yeah, it's like the OG.
Yeah. All right. Well, thanks again, Mike. For the audience, please definitely check out YieldMax. Please remember to like, comment, and subscribe, and join Discord. We'll look forward to seeing you all again soon. If there's any big questions I missed, it that need like a faster answer, maybe I'll just email you or something. Cool.
Yeah. I mean, send me an email anytime. And I'm, by the way, happy to respond to you. And then you can just pass on my answers. Happy to do that too.
For sure. All right. Thanks, everyone. Bye. All right. 1 second. I'm going to end it real quick.